Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Now, on to this episode's guest, Marvin Barth. Marvin is the creator of Thematic Markets and Seriously, Marvin. Thematic Markets is rigorous institutional quality research aimed at market professionals, while Seriously, Marvin presents more accessible takes on contrarian musings. Marvin doesn't have time to research at Thematic Markets. Both publications benefit from the uniquely broad perspective on the global political economy Marvin has gained from a 3-decade career spanning nearly every asset class, academia, central banking, finance, monetary, and international institutions. These include working at Barclays Investment Bank, Citi, the Federal Reserve Board, the US Treasury Department, and the Bank for International Settlements. Now, on to our conversation. So greetings and welcome, Marvin. It's fantastic to have you on the podcast show.
Thank you very much, Bilal. Very happy to be here.
Now, before we go into the meat of our conversation, I do like to ask all of my guests something about their origin story. So it'd be fantastic to hear what you studied at university, and was it inevitable you'd end up in finance and in policy?
No, in fact, I'd say that mine was incredibly path dependent. So, I've always been a very intellectually curious person. I was interested in pretty much everything under the sun. And so when I went to UC Berkeley as an undergraduate, I had no idea what I wanted to major in. I didn't want to graduate with a degree that said liberal arts degree, because that just sounded like, you couldn't figure out what you wanted to do, which was true. But, and fortunately, I had a roommate who was majoring in economics. And he told me, well, actually, the economics department at Cal has a 2-track program. And your diploma says the same thing, just an undergraduate degree in economics, right? One is the super math heavy, I'm going for a PhD. The other was you only had to take 4 upper division economics classes to complete the major. So I did that. And I studied, history, African-American studies, physics, all these things that I thought were fun, and did this degree. And then afterwards, when I graduated in the first, jobless recovery, and actually one that was at the time, the first time that significantly hit college graduates. So that was 1992. And I couldn't find a, quote, real job. And so I worked a bunch of odd jobs, and then finally decided, look, I need to go back to graduate school. And then it was like this question, what the heck do I do? And my answer was, well, ostensibly I did a degree in economics, and, actually that seems somewhat employable if I got a PhD in economics. So why don't I go do that? And so I did that. Studied, monetary policy, domestic monetary policy. That was what my dissertation was in. Somehow ended up in the international division at the Federal Reserve, the Board of Governors in Washington, was thrown into the hot seat literally the week of Russia's default, covering Thailand and Southeast Asia, which, were sort of leading the crisis at the time.
So that was that 97 or 98? So the actual
was
default?
1998. So I started there in August 1998.
Oh, wow. Okay. Right. As the
right. Literally the week Russia defaulted. Just, hey, why don't you figure this out? Yeah. So, the Fed was a great place for me because, as you know, a PhD trains you to go be an academic, to go be a professor somewhere, right? And one of the nice things about the Board of Governors is that they kind of let you choose your own path. There are people there who are doing the highest quality academic research out there, but there are also people who are obviously doing a lot of policy-based research. And I sort of took that latter path because I found that I was really interested in answering questions. And once I'd answered that question, I wanted to move on. Whereas, I'm sure if you've published papers before, you're going to spend the next 5 years doing robustness checks for some anonymous author, and you've long since lost interest in whatever the topic was, right? So yeah, I started out in emerging markets. When that finally sort of settled down, I moved over to the what was called the financial market section, which was really exciting because you got to brief the board every week, right? So I was in a rotation of 4 economists. So literally once a month, I was sitting across from Alan Greenspan, briefing him on what was going on in the global economy.
And just as an aside, then, what was he like?
He is truly an amazing individual. He really is. Um, as an intellect, so I wouldn't say he's the nicest person in the world, but and by the way, he's still one of my favorite Fed chairmen of all time. I think this is something we could get into discussing, like the current Fed. I think they could learn a lot from Alan Greenspan, and I know a lot of people say that there were a lot of problems with him, but Alan Greenspan single-handedly discovered the productivity miracle that was going on, because I remember being there and him just beating the crap out of the staff every week in board meetings and them saying, no, we can't find any evidence of a productivity boom. And he's like, look, I'm talking to CEOs all over the place who are telling me that profits are going up, that everything is humming, that they're finding all sorts of new productive ways. You guys just aren't looking hard enough. And in the end, he was right, and Larry Meyer, who was his great foil at that time, in his book, great credit to Larry Meyer, actually says that. It says, look, I was wrong, he was right. And I'll just give you one insight to just how amazing this guy was. I remember, the boardroom is immense. I don't know if you've ever been there. It's this huge, 20-foot high ceiling.
It's quite daunting.
Yeah. Gigantic table in there. And, if you're a briefer, you're sitting across from the governors. And then down at the other end of the table are sort of the division directors who, if you get in trouble, they're sort of the first line of defense against that. And then seated around the rest of the room are, seats for about 100 economists who, are the specialists who, if there's a detailed question, that none of us can answer, let's go to the economist who covers that specific issue. And I remember one time, Alan Greenspan asking the briefer from the domestic side about, some auto numbers miss, and saying, didn't we get some sort of, there was a plant that shut down in Michigan last year at this time, and that's what's really driving this number. And the briefer's like, looks over, of course, the division director, Mike Perel goes, and the auto analyst in the back comes up, flipping through his notes madly. Yes, Mr. Chairman, you're correct. I mean, this was the type of stuff this guy just came off the top of his head all the time. It was it was a really amazing experience to live through that, I have to say. So
okay, so that was true, all of that type of stuff about him, because I remember watching him. I mean, I was an analyst at the time, and I was just amazed in his speeches and stuff, just his handle on data, like micro data, which was just,
it was all
I just found stunning, for like a macro, Fed chair, like he'd be on top of all such a wide array of data points.
Well, not only that, but he, clearly to the point of, him figuring out that there was this productivity boom taking place before everyone else. And again, it literally was him alone against the entire rest of the board, the entire rest of the FOMC, and 225 academic economists staffing the Fed, all telling him he was wrong and him saying, no, you guys are wrong, right? He got the big picture. So he not only could go down to the details, but he had an amazing grasp of how all those details fed together into what was conclusively a big picture, something that I think the current Fed does extraordinarily poorly, in my view, but we can get to that later.
We'll come back to that one, yeah. So you worked at the Fed, and you could have had a path where you stayed at the Fed or, these types of institutions.
Yeah, so, one, sort of as a quote, reward for good work, I got seconded to the BIS for a year, which was a really eye-opening experience because, the BIS obviously is kind of like the central bank to central banks. and you had lots of colleagues from other central banks there, and you had all these meetings with other central bankers. So you really got to see how everybody else conducted monetary policy and what were the issues they were dealing with. And that was a wonderful growth experience. But when I got back from there, I sort of felt like I had sort of plateaued a learning curve. And the Fed being the wonderful place that I just described means that the opportunities for advancement aren't that great, right? Just because the people ahead of you are never going to leave. Right? Now, had I known that the global financial crisis was going to come 5 years later, then, maybe things would have been different, because all of a sudden that 225 economists exploded to, I think, like 400 economists. But in any case, I decided it was time for me to leave, and just coincidentally, at the time, one of my colleagues, actually a mentor of mine, Lewis Alexander, had left and gone to become the head of first emerging market research and then chief economist at Citi. And he had told me before he left, hey, if you ever want to go to the dark side, call me first. And so I did, and they happened to have a job in London. I went there. I did currency work for a few years. I'm going to summarize really quickly. I did that for a few years. I had an interesting opportunity to go back to Washington as the chief economist for international affairs at the Treasury Department. So I was the main advisor to the undersecretary who's responsible for international economic policy and for dollar policy, and be his primary advisor. That was a fabulous experience.
And which administration was that in?
So this was in the Bush administration, the final 2 years, just as we went into the crisis. I actually left just before the crisis blew up because, I had a bit of foresight that this was coming. And, I knew my job was ending in a few months anyway. And so then I went to a distressed debt fund out in Los Angeles. Which seemed like an odd pick, but basically they had 10-year locked up money. And I was like, hey, this is a great place. You don't have to worry about funding. This is going to be great. I'm going there. And on paper, it was a great idea because, supposedly I would be bringing a top-down macro view to their sort of bottom-up credit investing portfolio. But in the end, all these guys were basically, all the partners there, rightfully, I understand, they were successful in doing this. They felt the only way you can really make money is through value-added transactions. Nobody can forecast foreign exchange or interest rates or anything like that. Leave aside that their single most profitable trade ever was actually an interest rate swap I got them into, but fine. They really didn't buy that. So after a while, I sort of got bored there. I tried starting my own macro hedge fund, did the classic sort of rookie mistakes and blew myself up. And I had a quick pit stop at an outsourced chief investment officer where I was doing asset allocation and stuff like that. Fit wasn't right there. And so then I ended up going back to the sell side. So I was at Barclays. I was the head of foreign exchange and emerging market research for most of the last decade. And then decided I wanted to try something new. So I've gone out and started my own independent research.
Great. And we'll come back to that towards the end of our conversation. Now I did want to, given your level of experience, on the policy side, the private sector, in an administration as well, just sort of very high level. I mean, what are your thoughts on Trump 2.0? People are making parallels with Andrew Jackson from the 1800s. I mean, that's how revolutionary in some way Trump is, that we have to kind of go all the way back. Some people are making parallels to FDR, just in terms of the scale of the sort of the agenda, not necessarily obviously the politics of all, just in terms of the transformation. But how do you look at the administration from that perspective, from a historic perspective?
That is exactly the way I look at it. I think you've had, and I think it's really important to think about it in those terms. And definitely to jettison whatever thoughts you had from Trump 1.0, because Trump 1.0 was very clear. He didn't expect to win. He was not prepared. He was not even interested in being president. I mean, I have friends who were literally speaking with him every single day during his first administration, who were never Trump Republicans, who are not fans of his, and they will still tell you, look, one, this guy had no interest. Like, he literally would be bored in policy meetings. Two, he is very intelligent and very intuitive, whatever anybody wants to think about him. He is extraordinarily intelligent. And again, these are coming from people who are not fans of him. But he just had no interest. So that was then. But then I think, his loss, whatever I think all of us see this guy as a very egoistic, narcissistic person. I think most people agree on that. And, let's be fair. That's probably true of any president. Who goes to be president of the United States unless you are a massive egoist and narcissist? He's just very overt about it, right? And he clearly was really upset about that. And then, of course, you can talk about the fact that, I think legitimately you can say the Democrats did go after him with lawfare, and that was a traumatic experience. And his answer to this was, I'm going to come back, I'm going to make it, and I'm going to be the best president ever, or at least I'm going to be a memorable president, right? He doesn't want to just be any old president, just one of the 45 different presidents that have been out there, one of the two that got to come back within non-consecutive terms. And I think that's very important to think about his actions. And I think it gets to some of the things that markets are missing, is that he's got a burn the boat strategy here, right? He is going to succeed or fail, but he's going to make his place in history.
And actually, on that, then, I mean, one thing you said was in Trump 1.0, he wasn't particularly interested in policy, but now obviously he's had an array of policies. Where did he get those policies from that he's instituting right now? So what's the origin of these?
Look, I find this guy to be truly one of the most fascinating people in history. To go from somebody who literally had no interest in any of this stuff to come out with, and, I wrote a long piece basically saying he is literally the second coming of Andrew Jackson. And if you compare policy by policy, he is. There's no question about it. Even some of the I'll tell you a crazy thing. The first two paragraphs of the piece, I lifted straight out of a history of Andrew Jackson. And I only changed the words Jackson to Trump, Adams to, or Biden to Adams, right? Or vice versa, and Indian removal to immigrant removal, something like that, right? Literally, that's the only change I made. And if you read those two paragraphs, you say, "Oh my gosh, this is the Trump presidency," because he is Andrew Jackson. And so, what I find fascinating is that he has had that transformation, and he didn't have all this information. So he clearly took his time in the wilderness to go out and corral a whole lot of experts who fit with his framework. He does have a worldview, and they fit within that. And he said, here, I want you guys to design a policy platform that fits this. So if you want to think about where these ideas come from, in some sense, the grand strategy, I think, is absolutely him. The details are clearly not. That's, he never studied this stuff. He doesn't know this stuff. And you can see him like in the whole, my favorite part of the whole Zelensky blow up in the White House was him calling rare earths raw earths. It's like, yeah, we're going to get all your raw earth. It's just classic Trump, but there is a strategy there. There is a big plan, and he clearly invested a lot of time and effort in trying to shape a cohesive, as you put it, revolution. And I fully agree with that word. This is a revolution, and it is meant to your earlier point, overturn the revolution of FDR. And that's why I think it looks to a lot of people like this, trashing of the whole system. No, it's not a trashing of the whole American system. It is a trashing of the FDR style of Americanism and a return to Jacksonian America. You can agree or disagree with whether that's a good thing or a bad thing, but I think it's actually very important to see it that way, because that means that there is a historical precedent here and that this is beyond Trump. This is actually a broader MAGA movement, whatever you want to call it.
And that implies that even if Trump, assuming he does sort of step down and the next term,
or get
this is not just a Trump.
Frankly. You got to accept that's a realistic possibility.
Yeah.
Sorry
if Trump
to say
was,
but it is.
Yeah. But even if Trump was to, after the next election, he gets replaced by somebody else, it could mean that this MAGA movement could continue. This is not just a Trump-specific movement. That's what you're implying in what you just said. Is that fair? Or?
I think you will see something. Now, if he stepped away or was taken away early, God forbid, let's hope not, because I don't care what you feel about him. That would be a horrible thing for America and for the world in general. That would create a lot of chaos. But he does have a unique set of personality features that have allowed him to be rather more successful than I think anyone else on this bandwagon. I mean, you can go back, really, Pat Buchanan. You remember Pat Buchanan in 1992 ran on what campaign line? Make America Great Again, right? You can go back, Mike Huckabee, very similar platform. Rick Perry, very similar platform. So there's a long trend of these. Trump was the first one to make it work. I have one of my close friends is James Kanagasorian, who's probably one of the best, sort of data scientist, political analysts out there. And he actually says, look, this is, but I disagree with him on this. I think, to the point of your question, there will be something that will last beyond him, but he's right on this. Trump has this unique mix of just like self-effacing humor he does, as well as just in-your-face bravado that is almost laughable on its face, that allows him to get away with this and push through things that other people wouldn't be able to get away with. And that is quite unique to him, I think.
Okay, now let's go on to specific sort of policies. So, I mean, what would you say is the key sort of policy planks of the MAGA movement, would you say? Like, what are the ones that are kind of essential, and others policies which are kind of nice to have but not essential to the agenda?
Look, I think it's a revolution across the board: social, political, governance, foreign policy, domestic policy, monetary policy. It is all a massive, it is a revolution at every single level of our society and governance. And so it's hard to distill what are the things that are sort of most important, or essential.
Perhaps we can look at the things that markets are.
Yeah, that's what I was going to suggest. Let's focus on those, because I think those are, and they're also where I think markets get some things quite wrong. So, look, the tariff policy. I think this is a really, really important one. I cannot believe how many arguments I have on a regular basis with my fellow economists or people in markets, that tariffs are this horrible distortion that are incredibly destructive to the economy and to policy. And the assumption is that somehow we were actually operating in a world that didn't have massive distortions in it. And I would argue that's exactly the opposite of the case. We have had a world where China has been pursuing an industrial policy on a scale we've never seen before. I mean, the CSIS estimates that their industrial subsidies are almost 2 percentage points of GDP. And I think they massively underestimate the amount of implicit subsidy from the funneling of suppressed savings into the banking system to directed industries. And as a result, they have gone from a small share of global manufacturing to about 40% of global manufacturing in a little over 20 years, which is just a staggering achievement. And they've driven out of business industries all around the world. And people say, well, that's just because they're cheaper, because they're labor and they're more competitive at it. No, that's not true. If you look, first of all, I'm sure you're well aware, and you've probably talked about this yourself many times, that actually China stopped being a labor competitive, cheap production center 15 years ago, right? But also, if you look at the data, China's total factor productivity has actually been negative for over a decade. That means you would have been better off investing anything that was invested in China somewhere else and gotten a higher return on capital. That is just a fact. Those are in the data. That is a massive distortion on the global economy. And I've done some work showing that you can trace exactly the collapse in productivity in US manufacturing, and by extension, what you've seen in Germany and Japan and other places, to the fact that basically Chinese competition, which was all capital driven, undermined the incentives to invest and put all these industries into runoff investment. So effectively, a tariff wall is just blocking that process. And I suspect you'll get actually a big manufacturing productivity boom in the US because of tariff policy. So that's point number one. Point number two is we should really, if we're going to talk about taxes and their economic impact, we should put them on level terms with each other. So, one of the things that the big, beautiful bill is doing is, making permanent the 2017 income tax cuts, right? And if we hadn't had that, next year, we would have had a massive increase in taxes, about 1.8 percentage points of GDP. Now, if you use standard fiscal multipliers, and by the way, I'm talking about ones done by Christina Romer, who was, Barack Obama's Council of Economics chair. So I'm not cherry picking some Republican numbers. I'm talking about a hardcore Democrat here, and a really good economist, by the way. I don't want to suggest that her estimates are biased anyway, but if they were, they would certainly be biased against taxes having such a big factor. She and her husband, David, estimate that the multiplier on that is -2 to -3. So the tax hikes that were embedded into the tax code for next year would have cut GDP by 3.6 to 5.4 percentage points over 2 years. That's a massive hit to GDP. Whereas if you take the worst estimates, and by the way, I think those estimates are off in a lot of different ways, for the tariffs, you're talking a 1% drag on GDP, and you raise more revenue. So how is this such a bad thing? This is just, I think it's new, it's different. And so people say, oh, it's new and different, it must be bad. And it's not what we're used to. But if you actually run through the numbers, it's not bad. And it makes.
But I guess one question on the tariffs was, I guess people can see the point, right, the China side. So, there was, Trump 1.0, Biden, there was this focus on China, export controls, all of these sorts of things. But what Trump did was he had tariffs all over the world, so he basically, Europe, Japan, all potential allies who could triangulate against China. So I think part of the angst around the tariffs is that, it's also against allies. And to have an effective policy to contain China, you really need it has to be a global policy. It can't just be US alone. So I mean, how do you respond to that?
Well, first of all, I'm not the Trump spokesman.
No, fair point.
I somehow often get forced into this, and I have no affiliation with the Trump administration. I didn't vote for the guy. This is just my analysis, right? But I will say it does seem to add up. What my perception is, to your question, is that the reality is, he did this in his first term. Biden followed up on it with export controls and all this. What did we see from American allies? Zilcho, right? And the other thing is that obviously there was Brad Setzer has done a great job documenting the, re-export to third-party countries into the U.S. of Chinese goods. So when you put up a wall against just China, it's like, putting up a dam in the middle of a plain, right? The water just flows the other ends. So I think there's two things going on here. And well, actually, I would say, look, I have this phrase, the 3 R's of tariffs: revenue, reindustrialization, and reprisal. And so the revenue is just, this is a fiscal policy. Just look at it as that. The first argument is the reason why there's an across-the-board tariff is just to raise money, and it's more efficient than income taxes. And yeah, that's bad for everybody else, but hey, the U.S. has to do its own thing. And oh, by the way, everybody else has VATs, which, despite what the WTO says, if you work through the math, they actually are trade distortionary. So this is just basically offsetting VATs. The sort of reindustrialization point is to effectively deal with that flow around the outside of that China barrier. And then the third point is going back to that fact that, our allies, not only on the defense side, but on the China containment side in the economic sphere, have not addressed these problems. And so it's like, hey, you either need to address this problem or you're going to face higher tariffs. And one of the unappreciated, and by the way, I have no idea whether the Trump administration even thought of this or otherwise, but in my analysis, one of the things I think is actually an underappreciated brilliance of this whole policy is that it's effectively created a massive funnel of China's excess capacity into anybody who holds out. So, you already have the U.S. is responsible for 25% of gross demand in the global economy. I mean, and then, you take its current account and all that, it is responsible for far more of net demand in the world, right? So you put up a big wall and say, look, no China and nothing coming around the sides here. This already puts an immense amount of pressure on everybody else. With each new deal you do, you sort of narrow that funnel for who's getting all that excess capacity. And so it puts more and more pressure on holdouts. And I suspect that the story of the next 6 to 12 months is going to be that, is that you are going to see increasing pressure on everyone to do that. So that's kind of my answer to why this is happening and why they're putting more pressure on the allies, is because they can, and they're like, we're frustrated. You need to help out.
Yeah, no, that's a great point. And I think if you look on multiple different dimensions, essentially what's been happening over the last, well, kind of since the war, really, Second World War, that the rest of the world, or the allies of the US, has been free riding of the US in many, many different ways. And there was, I guess, some kind of implicit payment somewhere, but maybe there wasn't an implicit payment. And so what Trump has done, he said, look, let's make everything explicit now. These are the terms of the deal, and let's just be open about everything. And do you want to, be part of, a system which is advantageous to the US and potentially the partners, or not? Basically, everyone else has to step up. It can't just be the US.
Completely agree. And, I would say, by the way, the US shares the blame for that. I mean, it's easy for, Donald Trump or other Americans to say, you guys have been screwing us. But the fact is, we encouraged them to, right? We said, hey, yeah, we'll have this great security arrangement, and let's just create all this free trade, and we'll always give you a better deal just to make sure that you sign on to the deal. Because in the end, it was good for American business. And to your point, I think one of the things that's really interesting, and in many ways actually a very positive thing about Donald Trump, whatever else you want to think about him, is it is very explicit. It's very right there on the table. These are the terms, take it or leave it. Otherwise, we're going a different direction.
Absolutely. I think that is one of the interesting features of Trump, is he's very transparent. He just says and what he wants to do, and he does it. Whereas other politicians, often Democrats, kind of sometimes do the same thing, but they're very sort of slick with their, to borrow a phrase from a certain president from the 90s, but saying in such a language that makes it sound very friendly and nice and cuddly when they're often doing the same thing.
No, I mean, look, there's one aspect of that I really have a hard time or struggle with, certainly as a former government official and all these things, is just the corruption, right? And, I kind of, you didn't say this, I'm not putting words in your mouth, but one could say that a lot of the past presidencies, Democrat and Republican, were actually extremely corrupt too, but it was all hidden. Whereas Donald Trump is right in your face. I'm going to go make a lot of money out of this, right? And that troubles me. But at the same time, I'm like, well, if everybody was doing it, which kind of corruption do I prefer? The one where everybody kind of knows it's going on but can't see it and it undermines in this invidious way, or the right in your face, we should all be doing this? I'm not sure, but that's kind of the dark side of Donald Trump's transparency.
And actually on that, one of the big critiques of Trump has been that he's somehow upending the rules-based system that the US has. There's norms, which kind of makes the US kind of very, the sort of very consistent place to do business and such. So he's ripping up trade agreements. So agreements that you thought you had signed have been ripped up. There's all these people being rounded up, it's unclear whether it's legal or illegal. Trump's attacking judges. It just seems like, he's basically behaving like an emerging market dictator in many ways. Well, at least that's the sort of the critique that's coming from many quarters. I mean, what do you think about that? I mean, and do you think that will have an impact in terms of things like the attractiveness of the US for foreign investors to put the money in?
Oh, so look, I think this is a deep one. So one, there's the sort of whole legal aspect of it, and the other is how markets take that.
Okay. Yeah.
And I guess I disagree with that sort of, and I agree with you. It's very much, I think, a consensus view that's what's going on. In that one, and I just take it back to Andrew Jackson. Like, everything he's doing is straight out of Andrew Jackson, right? So it is not necessarily an abrogation of the rule of law or throwing the rule of law out. It is a different vision of what the US Constitution says. So we've been operating for 90 years now under a sort of FDR vision of what the US government should operate like: high centralization of the government in the federal government, not in the state governments, increasing delegation of those duties to bureaucrats, not to either Congress or the executives, and a view that the courts are somehow the arbiter of what's constitutional. And none of those things are actually in the Constitution, right? In fact, the Constitution actually makes very clear that the executive branch has equal power in deciding what's constitutional to the legislative branch and to the judicial branch. And that basically that's only resolved by 2 out of the 3 branches of government agreeing.
That's just a very good point. Yeah. We've just gone to this habit of thinking it's the judges that decide everything. But you're right. Not. The Constitution, it's that's the checks and balances of the US system. Yeah.
And nowhere is there this delegation to bureaucrats, right? Now, we may like various features of that. Me as a former federal bureaucrat, there were aspects of that I liked, right? But it's not in the Constitution. And that's kind of the battle against the bureaucracy there. And this, again, goes back to the exact same battle Andrew Jackson had against a much smaller bureaucracy back then, is, hey, I'm the only person who was elected in this executive branch. What I say goes. The rest of you are here to do my bidding because the American people elected me to do that. That's kind of the view of that. And whether you like that or not, that is actually what the Constitution says. And similarly, to this point about the separation of powers, right? Like, Andrew Jackson famously, supposedly, actually, I don't think there's actually a written record of this, but, said of the Supreme Court decision, a 5-1 vote to vacate the Indian Removal Act, which was agreed by the president, or, the executive branch and the legislative branch, that was unconstitutional. And he said, let the Chief Justice enforce it, right? But because 2 of the 3 branches had voted and they said, you're outvoted, right? So that's kind of, I think, part of what you're seeing. And by the way, you did see this very explicitly. Remember, Mike Johnson explicitly threatened the judiciary with taking away their funding if they keep blocking all these policies and not letting them go through. So there is a sense in which it is exactly that. The other thing I would say is that, if you look at the legal briefs, if you look at the executive orders, even his biggest detractors will highlight that they're actually extremely well crafted in law. And so this is a hyper-legalistic administration. It just has a very different view of what is constitutional or not. Now, to the market point, it is a shock. It's a massive shock, right? This is not what we've been used to. And you also, you do, especially with the stuff we talked about with the corruption, you kind of do have to say, is this a banana republic? What am I dealing with here, right? Now, I guess this is where I have a big difference with markets, is that I would say, yes, that does mean that the risk premium on all U.S. assets should be higher. But where markets have in many ways reacted like it should be higher in relative terms, I would say that's absolutely false, because actually if the US got riskier, everywhere else in the world is a hell of a lot more risky now, right? Because the reason why the US is exceptional is not because of those institutions. That helps. The US is exceptional because it's hidden behind 2 big oceans, has infinite resources, has decent institutions, has an immense economy, has giant liquid markets. All of those things are not changed. Oh, by the way, and is one of the only powers that can credibly defend itself. So all of those, that's what makes the US exceptional. None of that other stuff. So if the US is now riskier, every place else in the world is actually even riskier. And so the relative shift has not been in the rest of the world's favor. I don't want to fight that right now because, to your point, the narrative goes the other way, and you never want to fight the narrative while it's going. But I do think the fundamentals line up in the other direction, so you have to be ready to make that switch when it happens.
And before we talk a bit more about the rest of the world, I just want to get your take on US growth, US inflation, what the Fed will do, US stocks, say over the next 12 months, kind of medium-termish, sort of.
Yeah.
What's the general direction of travel?
So look, I think to the point of there just being a tremendous amount of volatility politically, uncertainty over what each of these things mean, we're going to see a lot of volatility in the data, but the sort of trend of 2 to 2.5% US GDP growth is going to continue, right? And, to the point that I raised earlier, if you look at the, actual effect of tariffs, the income effect of the tariffs probably subtracts about 1 percentage point of GDP. There's a substitution effect that probably adds to it, right? So the net effect there is, maybe 0.5% of GDP, something like that. On the other hand, if you look at the big, beautiful bill, assuming it gets passed, what we're talking about is about 2/3 of a percentage point of GDP in 2025 and also in 2026 in terms of fiscal stimulus coming through new tax cuts. So, people will talk a lot about, the cost of these tax cuts. That was really about, extending the existing tax cuts. That has no impact on the economy, right? Other than removing a downside tail risk. What's important here is the changes to the tax code since then, or to what we had last year, the no taxes on wages or tips and overtime, Social Security, things like that. That adds quite a bit there. Not a huge amount, but as I said, roughly offsets the tariffs. And then in the background, one of my key points for the last decade, that was sort of one of the reasons why I saw the massive rise in Fed funds and, was calling that would happen back in early 2021, is there's been this ongoing investment boom in the United States that most people have missed, which is all about automated localization. That as it becomes easier to substitute capital for labor, why would you disperse things on a globalized supply chain? Why not build them right next to your rich consumers? And that's increasingly what's been happening in the US. And COVID really re-accelerated that because it all of a sudden proved the business case for it. And then, of course, these tariffs are going to do the exact same thing. And so if you look at announced investment in the United States, I last totaled up these numbers at the beginning of May. So they were through the end of April, right? So still including past Liberation Day. And there's $2 trillion in announced investment in the United States versus the total for the entire European Union year to date is $7 billion. Right? The difference is just off the chart.
And the announced investments in the US, I mean, how much of them are linked to the IRA and, all the different Biden stimulus bills?
So most of those are all new stuff this year. A lot of that stuff had been announced previously. So this is all just new announcements.
Okay.
Right. But your question is still a valid one, Bilal. You could say, well, look, this is because Orange Man Bad is going to beat my business badly if I don't announce something really big in the United States. And so you could say a lot of this stuff is fluff. And I'm guessing some of it is. But, a lot of this stuff like Starlink, NVIDIA's investments, things like that, these are not fluff. These are real, actual investments in the United States that are brand new. We're going to do new stuff here. But even if you said, look, only 10% of this is real, that's still an order of magnitude greater than what you're seeing for the entire European Union, despite Germany's pledge to go spend tons of money.
And you mentioned the Fed. I mean, where does that leave the Fed? We had a meeting from them recently. They revised up the inflation forecast, revised down growth. There's a bit of debate around timing of cuts, but most people think 2 cuts this year, perhaps. What's your base case for the Fed? And secondly, we touched on this at the beginning of the call. What's your thoughts on Powell?
Yeah. My call all year has been they won't cut this year, and if anything, actually the risks are skewed to another hike.
Oh wow. Okay. And what's the rationale for that?
Now, let me just add a caveat there that the latest inflation data is giving me some pause about that upside risk. Okay. But the basic point is that, look, R-star is actually a lot higher than they think. And they've continuously gotten this wrong, which will sort of get to your second question about Powell. They've just gotten this wrong over and over and over. Like, I mean, one of my favorite points is when they decided to cut by 50 basis points because rates were so restrictive. At that point, 1-year TIPS yields had been 3% for 2 straight years. Inflation was above target, and US GDP growth was averaging 0.5 to 0.75% above what they say is neutral or potential, right? Where's the restrictive part here? Like, they are so far out in space in terms of their realistic assessment of where neutral is or where potential growth is. It's just ridiculous. The evidence is absolutely clear they're totally wrong. So I thought that their cuts last year, and I described them at the time, were a policy error. I think they would probably continue with their policy error were it not for their battle with Trump. And I think they want to show that they're independent. And the fact is, if you look at the key driver of inflation, in my view, has been inflation expectations. And, we had cost shocks, we had demand shocks, we had all those things in the past, and we still had, this trend decline in inflation in the last decade. What made COVID different? Yes, the cost and the demand shock were bigger, but it was really, they went into that telling people, you should expect more inflation. We're going to do everything in our power to create it. Well, guess what? People believe them. And if you look, yes, every possible measure you can have of consumers shows that inflation expectations risen. One of the things that changed for them this year is you could actually see it in long run inflation expectations. And if you look at the New York Fed survey of consumers, which is really great because they break it down by demographic, and you can really see who's driving this. But they also have this question on inflation uncertainty. Everyone's inflation uncertainty exploded this year because of course, the Trump policies. So if you're sitting in their seat and you've got inflation above target, and it's been above target for 5 straight years now, you really can't take the chance to cut right now, especially when Orange Man Bad is going to slam you any chance he gets, even if you're cutting rates, right? Because he'll flip on a dime. And so I think they're on hold, but if I'm right that actually economic activity surprises to the upside of what certainly, as you said in the FOMC last week, they sort of forecast as a worsening of the underlying economic conditions, then I think they're going to be potentially pressed to hike.
And then the rest of the world, you alluded to the fact that the rest of the world is not in such great shape. So let's start with Europe.
Yeah, Europe, I think, is an absolute disaster. I'm just amazed at how bullish markets are. And I guess nobody's really super bullish, but they're just like, oh, well, in relative terms, they look better. There's a committed minority out there that does think, oh, well, Germany's fiscal package is really going to change things. I think that's absolutely ridiculous. So, one thing is my sort of view of fiscal policy. First is like, let's just leave aside my personal views of fiscal policy. The fact is that fiscal multipliers for spending are between 0 and 1. Okay. So they're not big. So you're not going to get a lot of bump out of what Germany's talking about. But if you add in, here, and again, this is my personal view, but it's also well validated by research. If you look at the work of Alberto Alesina, Francesco Devazzi, and what they show for highly indebted economies, which Europe, basically every advanced economy other than, say, Sweden, and crucially Germany, is highly indebted. And so as a result, what you find at high levels of debt is that fiscal policy is actually very Ricardian, right? So it has the reverse effect of what you expect. Now, why that's important for Germany is the anchor of fiscal stability for the rest of Europe. And so, we all give great credit to Mario Draghi back in 2014, whatever it takes. That was only possible because he knew, and all of us in markets knew, he had Germany's backing, and Germany's balance sheet was sort of effectively backing credit underwriting the whole rest of Europe. If Germany blows out its debt profile now, all bets are off. And so if it's at the same time doing nothing to raise its potential growth, this is a disaster. This is actually a really bad outlook for Europe. And then you see what's
they get higher debt without the productivity story. Yeah. So yeah,
exactly. And their energy policy is terrible. We saw that with Spain. The increasing use of renewables, whatever they want to say about it, that blackout was caused by the fact that you have too many renewables in the system, therefore you don't have enough inertia. And the cost of fixing that, the EU itself estimates in the trillions of euros. Well, how are they going to do that and defense spending and improve their productivity? And, oh, by the way, have you seen what's gone on with the price of natural gas that they're now having to import because they can't get it from Russia anymore? Europe is a disaster. It's just
so. What does that mean for the dollar? Because one of the consensus views seems to be dollar weakness here. Yeah. But from what you're saying, it seems to be a bullish dollar environment.
Yeah. So look, I wrote a piece a few years ago. It was actually the piece I launched Thematic Markets with, which is, and it's all about these dollar cycles, which, you and I are both ex-currency analysts, right? So, we're very familiar the picture of the dollar, and, you got your three big peaks and troughs over the last 50 years, right? And one of the great questions out there is what drives these things? Because they're not related to business cycles. They're not related to like interest rate cycles. They're too long. They're like 17, 18 years long. And I'll spare you the details, but I basically do a bunch of sophisticated econometrics to isolate it to, they're actually innovation and productivity booms that originate in the US and then diffuse out to the rest of the world, which then means that their marginal product of capital goes up, draws capital out of the US, and the dollar falls, right? So that's what's driving it. First, it starts in the US, their dollar goes up as capital comes in, then it diffuses the rest of the world, dollar comes down. Everything I can see right now says that the US is still leading the capital cycle, which means that the dollar is not going to fall, at least as a structural matter. What we're seeing right now, and this is why I said I wouldn't stand in the way of this, is a reallocation, probably closer back to benchmark rather than actually out of or underweight the dollar, right? And you've got to kind of get through that. And once you get through that, then I think you will see the dollar reaffirm itself. I do think that, Europe, for right now, seems to be a beneficiary of that. That's a big source of capital in the world, so that risk reduction is going there. Where does it stop? I don't know about you when you were doing currencies, but at some point you kind of do fall back on technical analysis, because if you're talking about positioning, like that's really the only sort of anchor out there. And if I look at sort of the big dollar movements or euro dollar movements of this cycle, the 38.2 Fibonacci retracement has been sort of the boundary condition each time. And so the 38.2% Fibonacci retracement comes in at 120.19 right now. So that's kind of my target for where you want to re-energize your dollar longs and euro shorts.
And, we haven't talked about the Middle East. Obviously, the sort of the conflict has escalated there, with Iran being kind of drawn into the conflict there. Oil prices have shot up. US, got involved as well. I mean, factors like this. I mean, how do you incorporate a factor like this? I mean, into economies and markets and such.
I mean, one of my big theses for the last several years has been the rise of uncertainty, and by that I mean not the usual sort of, we've got this uncertainty index that everybody mentions uncertainty in the press more often. No, it's really about increasing evidence of non-quantifiable risks. That is, risks that you don't know how to put a probability on, you have no sort of measure for. You might even not know what was on the menu, right? Like, I mean, if we talk about like COVID, right? If you and I had been talking in January of 2020 and I said, hey, by the way, in a few months, 7 billion people are going to be in lockdown, you would have been like, it's not on the menu, Marvin. But that's the world that we live in. And I think what we're seeing in the Middle East right now is exactly in line with that. And so the only thing I can say that is that's basically impossible to trade, right? You really need to focus on structuring trades that take very explicit quantifiable risks. So focus on those. And so one of those in this aspect is to my point about Europe. Europe is actually the most exposed to this, right? So I don't think the Straits of Hormuz are going to be closed. But there's a very direct effect we can see right now, which is that insurance rates for shipping have gone through the roof, which means that the cost of getting natural gas to Europe has gone up dramatically. And you can see it in TTF natural gas. The chain through European inflation, through everything else, this is, again, another bad signal for Europe. I think that's a very tradable thing. Otherwise, if you're an asset allocator, the only way to deal with uncertainty is sort of scenario analysis and, very patiently and persistently through time buying long-dated insurance for completely unrealistic things happening, because they will. And there is a process for doing that, or you can always hire my old friend David Dredge out in Singapore to do that for you.
He's been a previous guest as well a couple of times. So yeah, he's really good on those sorts of things. I did want to round off with a couple of personal questions now. One is, obviously you've been in markets for a while now. You've interacted with lots of smart people. So what's the best advice you've ever received on investing?
So I don't know about the best advice, but I would say, personal experience, which sort of accords with what I've heard, is Paul Tudor Jones, one of Paul Tudor Jones' maxims. So I heard long ago that Paul Tudor Jones will not hire any PM who's never lost money before. And I mentioned that, I launched my own macro hedge fund, blew myself up, classic sort of rookie trading errors. And after the fact, I was talking to John Brynjolfsson, whom you might know. He used to run the PIMCO Real Return Fund. And I was telling him about, what I did. He said, wow, I have never seen anyone so brutally diagnose every mistake they made in the process and how they could have done it better. He said, man, that is going to serve you so well. Right? And really it is, until you learn how to accept failure and pick yourself up and deal with it and learn from that failure. I feel I'm I haven't gone back to running risk professionally again. I don't actually have any interest in doing it anymore. But as an analyst, as someone forecasting things, I feel I am so much better now because of that experience. And I think Paul Tudor Jones, if that is true what he said, I think it's absolutely right.
No, that makes a lot of sense. We do have some younger people who listen to the podcast as well. Many of them are at university. Many of them will be leaving university to enter the real world. What advice would you give to them?
So look, as a young person, it's always best to try and do whatever you can to keep as many options open to you in the future, right? One of the things you'll find in sort of your sort of arc of the life cycle is that, opportunities expand when you're young if you cultivate that, right? And then as you get older, they actually contract. You have fewer and fewer options available to you. And so you should be doing everything you can to expand that. So really be intellectually curious, really try and understand, frankly, not to say, gosh, I did it right, but go back to what I talked about at the beginning about my sort of path through university and just studying all sorts of random things because I thought that they were interesting and fun because I use them all the time in my research. But the other thing is definitely do some serious quantitative work. And I know people will say, but ChatGPT or Claude or whatever can do these things for me. And that's true, but you have to know the right questions to ask, and you also have to know how to interpret those things. And that's an important skill that it's probably going to take a while for those engines to learn to do. And the fact is that quant stuff is a harder path. And you will always find that the harder path has fewer people on it and less competition.
Absolutely true. I'm also intrigued by people's personal routines, their daily routines, their productivity hacks, and those sorts of things. I mean, do you have any secrets there?
Well, no. I mean, first of all, my routine, I don't have much of a routine. I'm an entrepreneur. I am involved in a couple different businesses. So I'm like running in 50 million different directions at once. I also am an avid rower. I'm just outside my window here is the Thames and Putney, and when the wind and tide are right, I go row, and that's dictated by God, not by me. The only constant in my day is having coffee and conversation with my wife in the morning. What I would say in terms of productivity hacks, I'm just really bad at it. And I think there is a method to this, and I think it's important for people to remember this, especially if you do something in a sort of creative work. And I actually do view my work as very creative, is you have to have time to just sort of daydream and think about things. And so if everything is really super efficient and regimented, you're not going to have those creative thoughts. So I throw that
No,
out.
that's great. Yeah. I like that. And then on books, I'm always on the lookout for good books. What are some of the books that have influenced you?
Lots of different books influenced me. One that I surprisingly keep citing over and over in my research, and I do think is incredibly important for people to keep in mind in the world we're living in, especially in the age of Trump and the age of social media, is James Surowiecki's The Wisdom of Crowds. It's a really fabulous book, but basically he goes through and shows amazing example after amazing example after amazing example of how crowds, even of, just random crowds on the street, whatever, are much better at making decisions than even the best experts out there. And if anybody studied regression analysis, the answer is pretty simple and straightforward. It's basically that all of those people have little teeny bits of information. They may have a lot of error in there, but if you average across them, you get the right answer. And no one individual, no matter how smart they are, or no small group of individuals, no matter how smart and learned they are, have the same set of information. And so I think it's one really important for future leaders out there to remember, check with every person in the room, because somebody, that young kid who you're not particularly impressed with, he knows something you don't. I guarantee you. And then the other is that in an age where we keep hearing, well, we shouldn't let those stupid people who are uneducated vote. Guess what? Those stupid people who are uneducated actually know things you don't. And not only that, they're crucial to the functioning of our society. So if we're going to live in a democracy, we'd better be able to trust every single person we give the right to vote. And that should be everybody. So I think that's a really important lesson for us all to focus on.
Yeah, that's great. Great insights there. Now, the final question I had was, can you tell us a bit more about your what you're doing right now, company-wise, the research that you're doing? What's the best way for people to reach out to you, and so on?
Oh, I gladly will answer that question. So I have a independent macro research product that you can think of as sort of a global political economy view that cuts across all asset classes. And, I have a history of working in every asset class, so I will actually make recommendations across every asset class. And it's called Thematic Markets. I publish it on Substack. But most of my clients are actually institutional investors. And just for the heck of it, just because I thought it would be fun, I actually just started a second Substack, which is free for everybody, called Seriously, Marvin, which was actually my wife's idea. She said, you have all these ideas all the time that are just crazy, but you never have time to research them. Why don't you write them down? So, caveat emptor, I haven't researched them, but if you're interested in some non-consensus ideas about the world, go sign up for Seriously, Marvin. And if you want the hardcore research, sign up for Thematic Markets.
And that's fantastic. Well, once again, thanks a lot. Such an engaging conversation, provocative as well, and anti-consensus. I really enjoyed speaking to you, and good luck with all your various endeavors.
Hey, thank you, Bilal. This has been fantastic. You're an incredible interviewer. I was really impressed with all your questions. This has been a lot of fun.
You're very kind. Thanks a lot, Marvin.
Thanks. Bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.